All right, everyone, welcome back to TalkTickers, where we like to take these dense earnings calls and try to make some sense of them for you.
Break them down.
Exactly. And today we're diving into FedEx's latest report.
Buckle up.
Yeah, seriously. So high level, they seem to be holding their own. I mean, it's a tough economic environment out there, right?
No doubt.
But for the first time all year, their revenue actually went up, plus their operating income jumped significantly.
Pretty impressive when you think about the headwinds everyone's facing right now.
For sure, but there's always a but, right?
Right.
And in this case, it's their outlook for the rest of the year. They had to revise it, downward.
Yeah. I mean, it's understandable with all the uncertainty in the economy, and inflation still being a major pain point.
A major pain point for everyone, it feels like.
Yeah, absolutely.
So let's really unpack this. What exactly drove their performance this quarter, and what should investors be watching out for as we head into the rest of the year?
Yeah, let's get into it.
So first up, the numbers. They reported a 2% year-over-year increase in revenue.
Which, if you recall, is their first positive growth this year.
Exactly. So that's a big deal.
It is. And then their adjusted operating income, that saw a whopping 12% surge.
Yeah, 12%. That's not nothing. That's just they're doing something right in terms of, getting more efficient.
Oh, absolutely. They've really been doubling down on cost-cutting measures. And you could see it paying off. FedEx Express, in particular, had a really strong quarter.
Oh, yeah?
Yeah, they saw their adjusted operating income jump a full 17%.
Wow. So some parts of the business are really humming.
Exactly.
But then there's that full year earnings per share outlook that they lowered to that $18 to $18.60 range.
Right. And that's that caution coming through. The present looks pretty good in some areas, but those storm clouds, they're still on the horizon.
Right. So it's a mixed bag. So let's break it down further. What specifically were some of the positive factors that drove their performance this past quarter? I mean, peak season is always a madhouse, right?
Oh, tell me about it.
But they managed to deliver strong results, even with, a shorter time frame to work with and some truly wild weather thrown into the mix.
Yeah. It was a brutal peak season, with those winter storms and wildfires wreaking havoc all over the place. But they navigated it remarkably well.
Yeah, their logistical network really proved its worth. It's impressive.
It is. And that's alongside, remember their Drive program. It's all about streamlining operations and allocating resources smarter.
Right, Drive.
Yeah, well, they're on track to hit a solid $2.2 billion in savings just this fiscal year alone, just from Drive.
$2.2 billion. That's a serious chunk of change.
Absolutely. And in this economic climate, that kind of cost discipline is critical.
Absolutely critical. Now, on the revenue side, that 2% growth we mentioned earlier, that was mainly thanks to higher volume at FedEx Express, right?
Right. But there's a flip side to that coin, their freight division. Not doing so hot.
Yeah, what's going on over there?
It's a classic case of different segments facing different realities. So freight, they handle those big, bulky business-to-business shipments.
Right.
And that whole B2B sector is feeling the pinch of a softening industrial economy. We're seeing it across the board, not just FedEx.
Yeah, makes sense. Those higher margin B2B volumes are definitely taking a hit. And speaking of hits, their contract with the USPS, the Postal Service, that expired, right?
Oh, yeah. That was a big one. That created a $180 million headwind for them this quarter. Ouch.
Yeah, ouch is right. But they are expecting that impact to ease up a bit as we move into the fourth quarter. So, fingers crossed.
Fingers crossed. And let's not forget those severe weather events we talked about earlier.
Oh, right. Those were rough.
FedEx estimates that those storms and wildfires alone, knocked off around $70 million from their operating income.
Yeah, it's crazy how much these unexpected events can just derail things.
No kidding. It's a tough business.
So even with all those curveballs, they still managed to see growth in some key areas, which is, I guess, commendable.
For sure.
But let's zoom out a bit and talk about their long game. What are some of the strategic initiatives they're betting on? They seem to be making some pretty big moves for the future.
Big moves, absolutely. So there's Network 2.0, their grand plan to make their facilities more efficient, streamline everything.
Right. Network 2.0.
Yeah. They had to pause it for a bit during peak season, all hands on deck and all that.
Makes sense.
But now it's back in full swing. They've already optimized 5 stations in the U.S. just this year. And get this, they're aiming to revamp another 45 in the fourth quarter alone.
45? Wow. That's ambitious.
Super ambitious. And by the end of fiscal year 25, they expect about 12% of their global volume to be running through these new optimized facilities. And by the end of 26, that jumps to 40%.
That's a massive shift.
It is. It's a huge undertaking, but the potential payoff in terms of efficiency is, well, huge. And then there's Tricolor. Yeah, their strategy for, squeezing more out of their air network.
Oh, okay.
It's about getting more cargo on each flight, basically. They're seeing payloads up 9% year over year, and density is up 5%. And that's translating into some nice revenue growth, especially in their international export freight business.
Smart. Use what you've got, but use it better.
Exactly.
And then we have the elephant in the room, the planned separation of their freight business. That's a major move.
Massive.
And it sounds like they're not just talking about it, they're actually doing it.
Oh, yeah, they're making concrete moves. They've set up a whole separate management office to oversee the whole thing. Plus, they just pulled off a successful $16 billion debt exchange offer.
16 billion. That's a lot of zeros.
It is. And it's a sign that they're serious about this separation. It's all about giving both FedEx and the future, standalone freight company more financial flexibility.
Yeah, it's going to be interesting to see how that all plays out. But it's not just the big splashy stuff they're focused on, right? They also talked about acquiring RouteSmart Technologies.
Right. And that might seem small in comparison, but it's actually really significant.
How so?
Well, RouteSmart, they make software for, optimizing delivery routes. Think like getting packages from point A to point B, using the most efficient route possible. And FedEx wants to roll that out globally.
Ah, so even more efficiency gains on the horizon.
Exactly. It's not just about saving money. It's about improving delivery times, reducing fuel consumption, the whole package, pun intended.
Nice. And of course, in a competitive market like this, you have to highlight what makes you better, right?
Right.
And FedEx made sure to point out that their ground and home delivery services are faster and reach more places than, well, their main competitor, UPS Ground.
It's all about that value proposition. Customers want speed and reach, especially in the world of e-commerce.
Absolutely. Okay, let's break down each segment's performance a bit more. We talked about Express, how they saw that 3% revenue increase. What were the key drivers there?
So a couple of things. One, they saw an uptick in deferred service volumes, those less time-sensitive shipments.
Right.
And two, their base yield improved. That's basically the average revenue they get per package. And importantly, that revenue growth flowed down to the bottom line. They saw solid profit gains.
That's what you want to see.
Exactly. And their European operations are also doing really well, which is a big contributor to that overall adjusted operating income growth.
Europe, a bright spot in a sometimes cloudy world.
Indeed. They're actually aiming for a cool $600 million in total drive savings from their European operations alone by the end of fiscal year 25.
Ambitious. Now, what about freight? We know they had that 5% revenue dip. What's the story there?
It's all tied to those softer industrial volumes we talked about earlier. They're just shipping less stuff. And on top of that, fuel surcharges were down and the average weight per shipment decreased. So, triple whammy.
Oof, not good.
No. And that all led to an $80 million drop in operating profit compared to last year.
They're getting squeezed from multiple sides.
Yeah, but they're not just taking it lying down. They're focusing on getting more high quality revenue, basically going after more profitable business. Plus, they're beefing up their sales team, getting people with serious expertise in LTL shipping, less than truckload.
So playing smarter, not just harder. Now let's move on to grounded air. They had a pretty solid 7% increase in volume, right? What's driving that?
That growth is coming from both their B2B and their B2C services. And a big part of that is FedEx Ground Economy that's really resonating with residential deliveries.
Interesting.
Yeah. And it's not just volume, it's profitable volume. They're getting about $4 in domestic revenue for each Ground Economy package.
$4 per package? That adds up.
It does. And on top of that, they've been expanding their Sunday residential delivery coverage like crazy. They now reach almost 2/3 of the U.S. population.
Wow. So they're really leaning into that whole e-commerce boom.
Oh, absolutely. And they're expecting that Sunday expansion to actually start boosting their profits as early as the first quarter of fiscal year 26.
Smart move. Catch that wave. Now, lastly, international. They saw an 8% jump in export package volumes. What's behind that?
Well, it seems like the global economy, relatively speaking, is doing a bit better than some domestic markets. So that's driving up demand.
Okay, makes sense.
But here's an interesting tidbit. Their yield on international priority shipments, those faster ones, went up 8%, while their yield on international economy services actually went down.
So different strokes for different folks.
Exactly. It's a nuanced picture.
All right, so we've got some segments firing on all cylinders, others facing some tough challenges. But now let's talk about what they're expecting going forward. What did they say about their guidance and outlook for the rest of the year?
All right, so for the full fiscal year 2025, they're now projecting revenue to be, basically flat or maybe even down slightly.
Okay, so not expecting any huge growth spurts.
Right, and looking at the fourth quarter specifically, they anticipate overall FedEx revenue to be pretty much flat as well.
Flat.
Yeah, they expect some growth in those deferred service volumes, but they also have one less operating day in the quarter compared to last year, so that kind of balances things out.
Right. Got to factor in those little quirks of the calendar.
Exactly. And unfortunately, they're expecting the revenue decline of their freight segment to continue in Q4, but they think it'll moderate a bit. So, a glimmer of hope.
A glimmer. We'll take it. Now we have to address the elephant in the room again, that downward revision to their full year adjusted earnings per share outlook. Why the change?
Well, it comes down to two main factors. One, there's just a lot of uncertainty in the overall demand environment. Nobody really knows what's going to happen with the economy.
Right, right.
And two, inflation is proving to be even more stubborn than they initially anticipated, especially when it comes to things like purchased transportation, the cost of contracting out those trucking services and wages. Those are really eating into their margins.
Yeah, inflation is like a persistent headache that just won't go away.
The worst.
But on a more positive note, they are expecting their ongoing focus on, higher quality revenue and a further acceleration of their drive savings in the fourth quarter to help cushion the blow.
Right. They're really counting on drives to pull them through. They're aiming to achieve an annualized run rate of over $2.2 billion in drive savings by the end of this fiscal year. So, they're pulling out all the stops.
2.2 billion. That's a big number to hit. And they also adjusted their full year operating income outlook to $6.2 billion, which, lines up with that revised EPS guidance of around 18.30 at the midpoint. What are the major factors at play there?
So they're facing some serious headwinds, right? They're projecting a whopping $1.1 billion headwind coming from revenue net of cost.
1.1 billion.
Yeah. And that's being driven by a bunch of things. Pressure on their international export yields, base yield across the board taking a hit, those fewer operating days we talked about, and of course that pesky USPS contract expiration.
So a lot of things working against them.
That's odd. But here's the good news. Those drive savings, that projected $2.2 billion, they're expecting that to pretty much offset those headwinds.
So drive to the rescue, potentially.
Exactly. It really highlights how crucial their cost-cutting efforts are right now. It's make or break.
All right, so that's the near term. What about, a bit further down the road, fiscal year 2026? Did they give any hints about what they're expecting?
So no specific earnings guidance just yet, but they did lay out some of their key priorities and thoughts.
Okay, let's hear it.
Well, their main goal for fiscal year 26 is, pretty straightforward, profitable growth. But they're not naive. They're fully expecting the macro environment to remain challenging, especially in the first half of the year.
So cautious optimism.
Yeah, I think that's a good way to put it. They do expect to see the full annualized benefit of their drive initiatives kicking in, around $400 million, which is great. Plus, they're anticipating continued progress with their Network 2.0 and Tricolor strategies.
So those long-term bets are starting to pay off.
They're starting to, but they're also realistic about the challenges ahead. They're still going to be dealing with inflationary cost pressures, and that USPS contract headache will linger for the first 4 months of the fiscal year.
Oh, right. Forgot about that.
It's the gift that keeps on taking. But there is a light at the end of the tunnel. They're expecting those big, juicy cost savings from Network 2.0 to really ramp up in fiscal year 2027.
So 2026 is a year of transition, of weathering the storm, and then 2027, hopefully brighter skies.
Fingers crossed.
Fingers crossed. Now, last but not least, let's talk about their capital allocation strategy. How are they using their cash? What are they prioritizing?
Well, they're big believers in returning value to their shareholders. They've been buying back a lot of their own stock. In the third quarter alone, they spent about $500 million on share repurchases, bringing their total for the fiscal year so far to $2.5 billion.
$2.5 billion.
Yeah, and that's right on target with their plan for the year. They're on track to return a total of $3.8 billion to shareholders this fiscal year through those buybacks and dividends.
So keeping those investors happy.
Happy investors are good investors.
True that. And they've also been making some adjustments to their capital expenditures, right? They lowered their planned CapEx for this year to $4.9 billion, down from $5.2 billion last year.
Right. It's all about making sure they have enough free cash flow. They've got to be prudent, especially in these uncertain times.
Makes sense.
But they're not cutting back everywhere. They're actually investing in some shiny new toys.
Oh, like what?
Well, they just struck a deal to buy 8 brand new and 2 used Boeing 777 freighter aircraft.
Nice. Fancy new planes.
Exactly. Deliveries are scheduled for 2026 and 2027. And they managed to snag them at pretty attractive prices, which is always a bonus. And these new planes will allow them to retire some of their older, less fuel-efficient aircraft.
So modernization is key.
Absolutely. It's about staying competitive, both in terms of cost and sustainability. And they're actually pushing back the retirement of their MD-11 fleet all the way out to fiscal year 2032.
Really? Why is that?
Well, it gives them more flexibility with their network. Plus, it helps them minimize those big capital expenditures on aircraft in the near term. They're playing the long game here.
Makes sense. Save money where you can, spend where it counts.
Exactly.
So big picture, it seems like FedEx is really trying to adapt and evolve in this, pretty unpredictable environment.
They are.
They're focused on getting more efficient, managing their costs really carefully, and they're making some pretty big long-term investments in their network and technology. Plus, they're keeping those shareholders happy with those buybacks and dividends. But those near-term challenges, those are real.
Oh, yeah. They're definitely not out of the woods yet. And that lowered earnings outlook is something investors are going to be scrutinizing very, very carefully.
For sure. It could be a sign of broader trouble brewing in the transportation and logistics sector as a whole.
It very well could be.
But it's not all doom and gloom. I mean, the progress they're making on those strategic initiatives like Network 2.0 and the freight separation, those could pay off big time in the long run.
They could. And they might take a while to fully materialize, but the early signs are promising.
And you got to give them credit for continuing to return capital to shareholders. That shows a certain level of confidence, even amidst all the uncertainty.
Absolutely. They're not hoarding cash. They're sharing the wealth. And those investments they're making in modernizing their fleet, that's a smart move.
It is. It positions them well for the future, especially when it comes to international freight.
Right. And let's not forget their commitment to e-commerce. With that Sunday delivery expansion, they're not just reacting, they're anticipating future trends. And the fact that their deferred services are doing well, that shows they're able to manage their yields effectively, which is huge in this kind of environment.
And their European operations are humming right along, so there are definitely some bright spots.
Bright spots indeed.
All right, so that was a lot to unpack, but I think we covered a lot of ground. Now it's time for our favorite segment where we, let our imaginations run wild. It's the This Is Not Financial Advice segment.
Always a good time.
Always a good time. So based on everything we've just discussed, what's an outrageous but plausible trade idea that comes to mind?
Okay, so given how aggressively FedEx is cutting costs with their Drive program and the potential for some big long-term efficiency gains from Network 2.0, but also acknowledging that their freight division is hurting because of that soft industrial economy.
Yeah.
Here's a thought experiment, a pairs trade. Hear me out.
Okay, I'm listening.
Go long on FedEx, but at the same time, short a major industrial manufacturing ETF.
Interesting. Explain the logic.
So the thinking is this. If the industrial economy continues to sputter, or even, dips into a recession, which FedEx's revised guidance sort of hints at as a possibility, then that short position on the industrial ETF should provide some downside protection.
Okay, makes sense.
But if FedEx, through their internal efforts, particularly in their Express and Ground divisions, manages to outperform even in a weak economy, then that long position on FedEx could still generate some nice returns. Plus, there's that upcoming separation of the freight business that could unlock some hidden value that the market hasn't fully priced in yet.
So it's not necessarily a bet on a booming economy, but more about betting on FedEx's ability to outperform even if things get rough.
Exactly. It's a relative value play. But, and this is crucial, this is just a hypothetical scenario we're tossing around just for fun. Please don't anyone take this as actual investment advice.
Absolutely not. This is purely for entertainment purposes only. Your mileage may vary. Consult a professional, all that good stuff.
All the disclaimers.
All right. Well, that brings us to the end of our deep dive into FedEx's latest earnings call. We saw a company trying to do a lot of things right in a very complex environment.
They are.
What do you think overall about FedEx's transformation? Do you think separating the freight business is the right move? Will it unlock that value they're hoping for? Let us know your thoughts. We're always interested in hearing different perspectives.
Always.
And that's it for today. Thanks for tuning in to TalkTickers. We'll be back soon to break down another earnings report. Until then, happy investing, everyone. And remember, do your own research.
Always do your own research.
Disclaimer. The trade idea presented is for illustrative purposes only and does not constitute financial advice. Always conduct your own thorough research and consult with a qualified financial advisor before making any investment decisions.